Hello and welcome to a special episode of Advisor Upside, powered by ETF.com. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and I'm talking today with John Reed Stark, former chief of the SEC's Office of Internet Enforcement and an adjunct law professor at Georgetown University. We're going to talk to John about his comments about, or in social media posts about, Morgan Stanley's decision to let its 15,000 wealth advisors sell Bitcoin ETFs to its clients. All right, John, thanks for being here. Thanks for helping us out.
Absolutely. Thanks, Jeff.
All right. I want to set the stage here a little bit before we start talking. The Morgan Stanley, a little over a week ago, announced that it was going to let its 15,000 financial advisors start selling 2 of the 9 spot Bitcoin ETFs to its clients. And by selling, I mean soliciting the sale of these to their clients. That's different from a client coming to an advisor saying, I want to buy one of these ETFs. This is Morgan Stanley giving financial advisors the permission to go to these clients and say, would you like to invest in one of these spot Bitcoin ETFs? And to be clear, the spot Bitcoin ETFs that Morgan Stanley has allowed access to or the sale of is the BlackRock iShares version, IBIT, and the Fidelity version, FBTC. Now, combined, those 2 ETFs have more than $20 billion. They were launched in, I think, around January 10th, 7 months ago, along with 7 other spot Bitcoin ETFs. The money has been kind of flowing into those things. We know what Bitcoin has done over the past 7 months. Some volatility there, obviously, especially about a week ago when everything went volatile. But shortly after this news came out, and I also want to make the point that Morgan Stanley has said that it is only letting advisors solicit the sale of these 2 Bitcoin ETFs to clients with at least 1.5 million in investable assets. So it's they've obviously set a few bars there. But shortly after this news came out, John, you took to social media and kind of threw down the gauntlet. I don't know if throwing down the gauntlet's the right word. You basically spread out a kind of a blanket of fear, saying that, this is going to be a SEC and FINRA sweep. I think your words are the biggest in history. I don't want to put words in your mouth because we have you right here. Why don't you tell us why this is such a big deal?
Okay. Well, first of all, it's not that I threw down a gauntlet. I don't have any stake in crypto in any way, shape, or form. I don't have any crypto or digital asset clients. I don't own any crypto. So for me, it's just I've been teaching advanced securities regulation for 20 years, as you said, at Georgetown and Duke. And I was at the SEC for almost 20 years, including almost 11 years as chief of the Office of Internet Enforcement. And this just struck me as one of the most reckless moves, probably the most reckless move I've ever seen any broker dealer make. And I just wanted the financial advisors to really understand just how reckless this was and what kind of risks they were taking. Because when it comes to the valuation of digital assets, remember, investors are flying completely blind. They have no cash flow, no yield, no employees, no management, no balance sheet, no product, no service, no history of operations, no earnings report, no track record of adoption or reliance, and the list goes on. How can any financial advisor or broker or some self-proclaimed wealth advisor conduct a proper valuation and communicate a thoughtful and reasonable recommendation amid such a boundless data vacuum? So what are you going to say to your clients and remember, so there's multiple risks here, Jeff. The first is, of course, the SEC and FINRA. And in my group, the Office of Internet Enforcement, we had at least at any given moment five attorneys who had previously worked in the Division of Examinations. And if you saw any or learned of any registered rep that was any registered person or registered entity that was selling anything that struck you as suspicious, whether it be prime bank securities, which are these bogus securities purporting to represent a secondary market for standby letters of credit, viatical securities, REITs, annuities, all of these kinds of illiquid, kind of complex investments, you're always going to look a little deeper into it. And you can, with the snap of a finger, call up the Division of Examinations or walk over to their office and say, hey guys, this is something that's suspicious here. And they can immediately initiate a for-cause surprise inspection of that entity and that person. And what does that entail? That's a financial colonoscopy of epic proportions. You are going to be subject to subpoenas, document requests, every single text, email, anything you've ever written in any way, shape, or form
Okay,
is
hold on,
immediately
John.
must be
I'm
produced to
gonna,
the SEC.
John, I
Mhm.
got it. We're getting a little far afield here. What I want to focus on here is, well, a couple things. First of all, the points you made about crypto being, there's no dividends, there's no assets, there's no income. I mean, in some ways, you could say that about gold also. There's that also doesn't produce any dividend. It doesn't have any employees, but people invest in it, and people invest in art. People invest in a lot of things. But that aside, the point you made about the recklessness of it, that's kind of what I want to get into. I mean, these things have been approved by the SEC, a place where you used to work. These are obviously, you got to imagine,
Wait. What do you mean by Jeff? What do you mean by approved? You need to
they've been
define
approved
that.
for sale. They've been approved for use. You can
Not for the merit of the investment. I mean, this is one of the only securities in history I've ever seen when the SEC approved this by 3-2 vote, these
Mhm.
ETFs. They actually issued on the same day a boatload of admonitions, of warnings to investors to stay away from this investment, which is just highly unusual. And again, I think it's almost unprecedented. So let's be clear about what we're saying about approval. The SEC might say, because the SEC is not a merit-based agency in that sense, they don't say, hey, this is a good investment, go out there and get it.
Mhm.
They say you've met all the requirements under the federal securities laws to offer this to the public. Now, let's talk about risk disclosure, because the thing is, you can't sell something like crypto without disclosing the risks. So if you take a look at the risks, if you look at, for instance, any of these limited liability partnerships and other sort of public offerings or private offerings that offer crypto and Bitcoin and whatnot, and I've reviewed all of these documents, you'll find, in the usual offering document, maybe 100 pages long, all sorts of disclosure, but you'll find that 2/3 of the document is risk disclosure. And the risk
Mhm.
disclosure is unbelievable. When you look at it, it says things like, we have no idea what we're doing. There's all sorts of volatility. There's all sorts of regulatory uncertainty. There's all sorts of cybersecurity risks. That and this investment is a mathematical computational equation. And we have no idea whether it'll be 0 tomorrow or 100 tomorrow. So if you read this risk disclosure, that anyone would invest in it after reading that risk it's just anathema to me. I just don't get it.
Yeah, I hear what you're saying. I know that there's disclosures out there, and I think you know this, John. I don't have a dog in this fight. I don't really
Mm-hmm.
care if people buy Bitcoin ETFs or not. I'm just trying to, make sure we are clarifying the points that you're making. And yeah, risk disclosures are throughout investments and prospectuses. Most people don't read them like you do, but they're there, as we all know. But why is this situation with Morgan Stanley so unique? I mean, these ETFs have been out there for sale and purchase for 7 months. Financial advisors across the industry, financial advisors as the largest users of ETFs in general, have been investing in them on behalf of their clients. Individual investors have been investing. Are they not subject to the same kind of potential regulatory oversight, or as you say, SEC and FINRA sweep as these advisors at Morgan Stanley?
Oh, it's much different. Yeah. Well, here's why I think it's different. And certainly coming from an enforcement background, having worked in the Division of Enforcement for almost 20 years, this is how I think enforcement attorneys look at it, is
Hmm.
that a financial advisor, I love the idea of the person I buy an investment from having an incredible credential, having incredible experience. So there's all sorts of credentials that are very important for investment advisors. Why is that? Well, the law expects them to have a fiduciary relationship with their client. What does fiduciary relationship means? That means you really have to understand your client's financial wherewithal. You have to understand their family, their real estate holdings, every single thing about them before you make this recommendation. You have a duty of trust toward them, a duty of disclosure, a duty of fairness that rises above any other level of relationship in the course of financial transactions. So from a financial advisor, and again, this is a registered investment advisor that I'm talking about,
Mm-hmm.
or even and what the SEC has done over the past decade is really moved that fiduciary expectation to registered reps as well, even if they're not registered investment advisors. So there's this general notion that, hey, you really have to understand your clients. Now, here's a good example. If you look at this, the two biggest credentials in the area for investment advisors are the certified financial planner and the certified financial analyst, right?
Mm-hmm.
Great credentials. But to me, one of them, the certified financial analyst, CFAs, they've really been very, very disappointing about crypto. They've about digital assets. They almost seem to be promoting it, which strikes me as bizarre. At least that's my opinion. The
Mm-hmm.
CFP, on the other hand, who has a rigorous enforcement department, a very, very robust, they've revamped their entire enforcement department. They've rewritten all their standards. They put out like a 16-page document with respect to digital assets and what their expectations are for a financial advisor. I'm sorry, for a CFP
Mm-hmm.
who offers this, who, as you said, solicits clients to invest in digital assets. And if you look at those 15, 16 pages, and then you look at the Department of Labor, the Department of Labor has carved out sort of the SEC jurisdiction for retirement funds, like 401ks and IRAs. Those are the jurisdiction, it's the jurisdiction of the SEC, but also the jurisdiction of the Department of Labor. They similarly put out guidelines. And I interpret those guidelines and the CFP guidelines as they're almost being essentially a presumption that you are breaching your fiduciary duty if you are soliciting investors in crypto and
Mm-hmm.
Bitcoin. And here's why. Because there's no way you understand what you're selling them. And there's no way your client understands them. And those are some basic things. I don't know what the fee arrangements are. I find it ironic that Bitcoin was created to disintermediate, to set up a way for people to buy investments without these financial behemoths in between them. And here Bitcoin is being used in exactly the same way that it was created not to be done. So it's so ironic to me that you're in these. So I don't know what the fee arrangements are, but
Are you talking about the expense ratio of the underlying funds, of the actual funds, the Bitcoin
no, I don't
funds?
know. I think there just needs to be a complete expose of exactly how much people make, how much advisors make. But look at the risk that this is a podcast for investment advisors. And
Uh-huh.
if I were an ETF, I wouldn't want the digital asset. I think ETFs are incredible products. They've done incredible things for people, and a lot
Mm-hmm.
of investors love them and give them all kinds of opportunities. It's a really novel innovation, financial innovation. I wouldn't want the digital assets and the Bitcoin and the crypto polluting that space,
Mm-hmm.
because look at the risk that an investment advisor or broker is subjecting themselves to if they sell these Bitcoin ETFs. First of all, they're going to get subpoenaed for testimony and documents. There's going to be this regulatory colonoscopy that I talked about of their records, their data, their conversations, which are all recorded, their texts, their documents, anything they've ever done.
Why
What
do
were you
you
going to
see
say?
that
Go ahead.
happening? Do you see that happening
Because
because clients are going to be upset that the price of Bitcoin goes down, or what's going to trigger that that
I'll tell you.
doomsday
Oh,
scenario that you lay out?
okay. We already know that right now, assuming unless Donald Trump gets elected, if President Trump is reelected as president, then things will definitely change. That's the subject of another podcast, but things will definitely change at the SEC dramatically. And
Mm-hmm.
all of the crypto enforcement efforts that the SEC has will pretty much grind to a halt, and they'll only be enforcing fraud. But generally, the SEC, the staff, whether it be the Division of Examinations or the enforcement staff, they don't believe that digital assets like Bitcoin is a good investment. And for good reason. The only thing that I've ever seen digital assets be used for effectively is crime, like
Mm-hmm.
ransomware, money laundering. If you want to bring million worth of crypto across the border, you can do it because it'll be in your computer and no one will know. So it's a way to shield yourself from anti-money laundering laws. But other than that, there is no proven utility, just a lot of aspirational blather. So the SEC staff, when you're looking at this, is what I was trying to tell you, is that if you're an SEC staff person, you see somebody peddling Bitcoin, you're thinking right away, hey, if you spit in the pool, you'll pee in the pool, like my dad used to say. And as soon as you see that being done by someone, you're thinking it's time to examine because we're going to find something there. Because how can you possibly recommend this investment to anyone? There's no tangible data to use to recommend it other
Uh-huh.
than pure speculation. And it's not a store of value. It doesn't function well as a currency. It doesn't function well as anything. It's, again, just a mathematical computational equation. So it's much different than gold or proven commodities that have been used in history. It's again just a mathematical equation dug up by a bunch of people who supposedly mined for those equations, but really just
Okay.
ran a bunch of computer programs.
We
How do you recommend that to someone? How do you say to someone, hey, this is great for you? You know, you're trying to build for your family, you're trying to save for your future, you're trying to save for your retirement. This is a great investment for you. What's the next sentence after that? And that's what the
I'm
SEC
not
will
the
look
one to
for.
make that argument, but
Mhm.
obviously, those arguments are out there. There's two sides to this argument for sure. I mean, the California Department of Motor Vehicles has put, I think, 42 or 40 million car titles on the blockchain. The state of Michigan has put 6.5 million in pension fund assets into Bitcoin. Uh,
That's absurd.
there
That's a breach of fiduciary duty that goes on.
Obviously you're
Mhm.
not alone in your feelings about crypto and crypto investing. Vanguard, a well-known gigantic asset management firm, ETF provider, they have said that they will not launch a Bitcoin or crypto ETF, and they will not even allow for the trading of those on their platforms. Morgan Stanley, as I neglected to say at the top, is the first major brokerage firm to even allow their advisors to solicit clients to sell these, and they're only allowing these two specific ETFs from these two providers. But the other side of that again is it sounds like you're saying, John Reed Stark, that the Securities and
Mhm.
Exchange Commission and BlackRock and Fidelity, which combined probably have more lawyers than I have socks, are all wrong in allowing these things to be out there available to the public. I mean, you used to work at the SEC. Are you saying that they just totally rolled over and let this happen?
Yes, I would absolutely say that. Gary Gensler, it's a difficult thing to understand because Gary
Uh-huh.
Gensler has come out. The SEC has brought probably over 200 cases now against different crypto firms for failing to register. And they
Mhm.
started out by bringing cases, they had these initial coin offerings and the SEC went after those, and those were found to be absolutely violations of securities laws. Then they have the SaaS, the simple agreements for future tokens, which all the big law firms and big financial firms said were going to be the next big thing. The SEC brought those cases to court.
Mhm.
Then there were all these recommendations that all these celebrity recommendations, the SEC brought them. Crypto lending programs, the SEC brought those. Crypto intermediaries, Coinbase, Binance, all of these cases against crypto intermediaries for failing to register. So the SEC has been very, very aggressive when it comes to crypto. And it's pretty much won, I would argue, every single time they've been in
Mhm.
court. I mean, there have been one or two cases here and there where maybe they've lost a summary judgment or something, but generally, if you read those cases carefully, and I've read every single one, they're overwhelming. And judges have gone to extensive efforts writing 100-page opinions about why these various digital assets are securities. And it's very simple. You have the 33 Act, which said after the Depression, the Congress wrote the 33 Act and said, hey, anybody who's investing has got to register those securities. Then the
Mhm.
34 Act, hey, anybody who's transacting has got to register as a transaction. And the 40 Act, hey, anybody who bundles or anybody who recommends securities, like an investment advisor, has to register. So these are basic fundamental principles that have been around forever. And the SEC has enforced those. And the ETF, I was shocked. I was definitely with the to dissenting, and Gary Gensler, remember, he went against his own party. The
Hmm.
other two commissioners voted not to let the ETFs be used because it's a terrible danger to investors. And you're right, Jeff. I think you're right in that you are, even though you're saying in all your investor protection materials, don't invest in this. This is a terrible idea, crypto. You are legitimizing it by letting these ETFs move forward. And I think you make a really good point along those lines. But that doesn't mean that an investment advisor who has a fiduciary relationship with their client, which is the highest duty of trust and confidence that you can ever have in the context of a financial transaction,
Hmm.
has got to really, not just in making the recommendation, make sure it's suitable, has to understand it, has to be able to communicate everything about that investment. Like, why should I invest in Microsoft? Why should I invest in Apple? Why should I invest in Ford or GM? There should be a reasonable discussion and a thoughtful analysis. And how can
Well,
you do that when there's absolutely not just a vacuum, there is zero empirical data? Without any people, without any products, without anything,
yeah,
you
well,
can't
I can't.
make
I'm
this
not.
argument.
Just like I'm not going to make the case for why this is or is not an investment. I'm not going to speak on behalf of financial advisors, but my
Mm-hmm.
sense, and some of that is based on actual conversations with financial advisors, is that they see this as an investment opportunity that has growth potential. Over the past 6 years, the price of Bitcoin, volatile as it is up 1,000%. The Dow over that period is up 60%. 60% isn't bad, but it's a long way from 1,000%. That's what I see as the potential opportunity that financial advisors are selling to clients and that investors want a piece of.
Let
But
me address that.
okay, yeah.
Go ahead. Go ahead.
No, you
What
go
is
ahead
that?
because then I have one
Okay.
more thing
Yeah,
I want to wrap up
sure.
with.
Uh, Absolutely. So let me address that. Just because something has gone up a lot, if you look at penny stocks, microcap stocks, there's a lot of brokerage firms don't even let you invest the securities. And the
Uh-huh.
reality is that when it comes to penny stocks and micro stocks, if you're making that recommendation, you're saying, hey, this is an opportunity for huge growth. At least in those situations, you could say this guy's got some new technology that's going to cure cancer. It's, of course, when the SEC digs into it, it's typically going to be a lie. But just because crypto has gone up, that means that investment advisor is saying to their client, hey, buy this because the greater fool theory is a worthy investment strategy. And there is some possibility to that. Like if you're investing in Warren Buffett and you just want to say, hey, Warren Buffett bought this security. I don't know anything about it, but the mob likes what Warren Buffett buys. So I'm going to
Uh-huh.
go buy some. And, so I guess that's a legitimate strategy, but not from an investment advisor to a client where they have a fiduciary relationship. So what's the next sentence? This went up a lot, so you should buy it. And if the client says, well, why did it go up a lot? The answer is going to be, because of the greater fool theory, because the mob just thinks it should go up. And, Jeff, one of the things we haven't touched on at all is just how incredible the manipulation is that goes on with crypto. There's no
Mhm.
transparency into any of these marketplaces. These exchanges are not subject to the Division of Examinations at the SEC or FINRA. FINRA, of course, just broker dealers or any other kind of scrutiny. So who knows what goes on in these? Remember what we read about Binance, the manipulation that went on where the CEO is sending texts back and forth about how to manipulate the marketplace and how to and so we have no idea. There's no transparency into what
Right.
goes on in that marketplace.
Well,
So by definition, how can anyone recommend
I,
a
I,
product when there's no transparency into the marketplace?
I mean, good points all, but we all know that fraud and volatility happens pretty much across every financial investment and security, i.e., Bernie Madoff. But the final thing I want to ask you here is when is this reckoning coming? When will the enforcement actions come on the Morgan Stanley brokers? And will that be triggered by I guess, a pullback, an extreme pullback in the price of Bitcoin that triggers a whole bunch of clients belly aching about it?
What a great question. Okay, so first of all, just like with Madoff, okay, Madoff, by the way, was a massive SEC failure. So I just don't like to use that as an example because eventually he did become a regulated, registered investment advisor, and the SEC examined him, and the examination failed. There's fraud everywhere in the marketplace. You
Right.
are absolutely right about that. But the reality is that in this situation, again, the SEC doesn't have the examination authority. So what next? When is this going to happen? Well, first of all, of course, whenever there's a big down market, that was the death knell for Madoff. It's the death knell for every con artist. Every Ponzi scheme goes down when there's a down market because
Hmm.
what happens is the flood of investors want to take their money out. And sometimes they want to take their money out of these. I think with the ETF, you can take it out whenever you feel like it. I really don't know. But some of these partnerships, you can't take it out. So
Hmm.
here's the point is that there'll be the market goes down, then there's a mad rush, withdraw your money and get your money out for your Bitcoin, and you can't get it. I mean, you know, it's so funny. My son and I went down to look at one of those Bitcoin, they call them ATM machines. They're not ATM machines, they're just money laundering machines. And they're in every supermarket now. You can put all your change in and get crypto. And I actually set up one of those accounts. And right away, they just took all my money and they never let me do anything with it. And I documented this all in an article. And there's just no oversight of any of these entities because you can't call the. Who do you call when this stuff goes wrong? So
All
in
right.
this case, for the brokers advising people to buy crypto, when the market crashes, of course, there are going to be multiple. There'll be many arbitrations. There'll be class actions. There'll be a digging into those records. But the reckoning is going to be sooner, Jeff, because this is, again, from an SEC enforcement staff member's perspective, this is like shooting fish in a barrel. They're going to rally into these firms to find out what these investment advisors and brokers are telling their clients. They're going to talk to all the clients and say, what were you told? I mean, who wants that kind of scrutiny? Also, you can recommend something that is wholly invested on because of the greater fool theory and no other reason. So
All
I
right.
just don't see the risk for an investment advisor in your audience. I just don't see the risk. So I guess I'm trying to look out for them.
No,
And
I
maybe
hear
that's
you.
Pollyanna, but you know.
I hear you, John. I appreciate your time. We're gonna have to leave it there, but man, was this good stuff. And let's stay in touch and stay on top of this, okay?
I
Really
love it,
good
Jeff.
stuff.
Thank you very much. And thanks to ETF.com
All right.
for
Thank you, sir.
really giving me the opportunity.
All right, folks, want to thank our guest, John Reed Stark, for helping us out and sharing his thoughts and opinions on the decision by Morgan Stanley to let its brokers sell Bitcoin ETFs. This is going to be something we're going to stay on top of. We will, obviously, it's evolving. We'll see if he's right. Maybe there is going to be a wave of enforcement from this. Anyway, my name is Jeff Benjamin. Thanks for listening. Check out ETF.com and the Advisor Center, where we've got everything you need to help you run your practice. Thank you.